Advanced level business questions and answers. 3.7, analysing the strategic position of a business. Explain the relationship between mission, corporate objectives and functional objectives. Well, the mission is the overall aim of the business. Corporate objectives are the steps the business needs to take to achieve its overall aim. And then functional objectives are how the departments contribute to the corporate objectives. What is meant by corporate strategy and tactics? Corporate strategy is a long-term plan of how the business is going to achieve its corporate objectives. Tactics are short-term plans to achieve short-term goals. Suggest 6 different corporate objectives. Profit maximisation, making as much profit as possible. Profit satisficing, which is just enough profit to keep the stakeholders content. Survival, just staying in business, maybe to get the biggest market share. Social and ethical goals, and then mergers and acquisitions. State 5 internal influences on setting objectives. Type of ownership, whether it's a profit or a not-for-profit company. Short-termism, that is where the managers do not look far enough ahead. Leadership and culture. State 4 different external influences on corporate objectives. The state of the economy, technological advancement, government legislation, and environmental issues. What is SWOT analysis? Now, SWOT stands for strengths, weaknesses, opportunities, and threats. The strengths and weaknesses refer to internal issues within the company. The opportunities and threats refer to external events, that's outside of the company. Explain the table. This is an income statement, AQA profit and loss account. It shows revenues, cost of sales, overheads, gross profit, operating profit, and profit for the year. So sales is the revenue from all the products that have been sold. Cost of sales is opening stock minus closing stock plus purchases. At the start of the year, Coli had £100,000 worth of stock. Explain the table. This is an income statement, also known as a profit and loss account. It shows revenues, cost of sales, overheads, gross profit, operating profit, and profit for the year. So let's take a closer look at this account. So to start off with, we're dealing in units of thousands. Right. So sales is the revenue from all the products that have been sold. So sales for E. coli Limited were £1 million. The cost of sales is calculated by taking the opening stock, subtracting the closing stock, and then adding purchases. So at the start of the year, Coli had £100,000 worth of stock. That's the opening stock, and had £150,000 of stock at the end of the year. During the year, they bought a further £200,000 of stock. That's the purchases. So the value of the stock that was actually sold is £150,000. Now, gross profit is simply sales minus cost of sales. So gross profit is £850,000. Expenses are overheads not directly related to production. For example, salaries, rent, heating, lighting, motor vehicle costs, and depreciation. Operating profit is the gross profit minus total expenses. It is the profit on its normal activities. Income received is other revenues not directly related to its main activities, and interest payable is interest paid on loans that the business has taken out. Net profit is after all deductions. The company will pay corporation tax on this amount. The directors of the company then decide how much to allocate to the dividend, that's the amount given to the shareholders, and how much will be kept in the company as retained profit. So the overall net profit for the year is £570,000. What is a balance sheet? A balance sheet is a snapshot of a company's assets, liabilities, and capital at a point in time. The basic accounting equation states that assets equals capital plus liability. Assets is the value of everything that the company owns, must be equal to the capital, that is the money that the owners have put into the business, plus any liabilities, that is money which has been borrowed. The vertical balance sheet is set out such that assets minus liabilities equals capital. So let's have a look at the balance sheet for Tasty Bakery Limited for 2022. So starting at the very top, we have non-current assets. These are items not bought for resale and are used in the production of goods and services. So for our bakery, we have the factory, dough machines, ovens, vans, and fixtures and fittings. They come to a total of £100,000. Current assets, this is cash and other assets that are expected to be converted to cash within a year. This comprises stock, raw materials, work in progress and finished goods. Bank, which is simply money in the bank. Cash, money on the premises. And debtors, that's amounts owed to the firm. So we have a total of current assets of £11,000. Current liabilities, this is money owed by the firm that needs to be paid within the next year. This comprises creditors, stock and raw materials received but not yet paid for. Tax, this is any money due to be paid to Her Majesty's Revenue and Customs. Net current assets, also known as working capital, this is current assets minus current liabilities. It shows whether the business has enough money to pay its debts. Finance by explains where the firm has got its money from. The owners have invested £50,000 of their own money. Reserves are £45,000 worth of past profits that have been reinvested in the business. Non-current liabilities are long-term loans that are payable beyond a year's time. Net assets must be equal to owner's capital. So we have net assets, which comprise fixed assets plus current assets minus current liabilities minus non-current liabilities come to 95,000, and that has got to equal the owner's capital right down the bottom, also at 95,000. Define and explain gross profit margin. Gross profit margin is gross profit divided by sales times 100. For example, a GPM of 10% means that for every £1 of sales, the company makes 10p in gross profit. Define and explain net profit margin. This is net profit divided by sales times 100. For example, a 5% net profit margin would mean for every £1 of sales, the company makes 5p in net profit. Define ROCE. This is net profit divided by the capital employed times 100. It shows the percentage return on money invested in the business. Define and explain the current ratio. The current ratio equals current assets divided by current liabilities. It shows a business's liquidity. The recommended ratio is 2 to 1. The company should have £2 of current assets with which to finance every £1 of liability. Lower than 2 means a danger of running out of cash, but higher than 2 means cash is tied up in unprotected resources, such as holding too much stock or not chasing debtors. Define and explain the acid test. Well, the acid test is current assets minus inventory divided by current liabilities. The recommended ratio is 1 to 1. It shows the same as the current ratio, but excludes stock. Define and explain gearing. So gearing is non-current liabilities divided by total equity plus non-current liabilities times 100. Gearing shows how much of a business's capital comes from borrowing. If it is over 50%, it is considered to be highly geared. However, if it is under 50%, it is considered to be low geared. Explain inventory turnover. Inventory turnover is cost of sales divided by average stock held. This shows how many times over the business sold its stock during a year. Explain days payable. So payable days is equal to payables over cost of sales times 365. This gives the number of days it takes the business to pay its suppliers on average. Define and explain days receivables. Days receivables is receivables over sales revenue times 365. So this is the amount of time in days it takes a business to collect money from its customers. State 3 advantages and 3 disadvantages of using ratios. Well, the advantages are it's useful for looking at a business performance over time, for comparison with other businesses within the same industry, and assist management in decision making. Disadvantages or limitations of these are that it's all numerical by nature, so ignores things like the quality of the staff. Past data is not necessarily a good representation of future performance. And then it assumes that all data in the income statement and balance sheet have been correctly collected and calculated. What are the main marketing measurements? Market share, market growth, sales growth, portfolio analysis, product life cycles. What are the main human resources measurements? Labour productivity, labour turnover and retention, employee cost as a percentage of turnover, and labour cost per unit. What are the main operations measurements? Output, capacity, capacity utilisation, unit cost, fixed and variable costs, and depreciation. Now, depreciation refers to loss of value of a fixed asset over a period of time. What are core competencies? These are the unique features of business that give it a competitive advantage. Outline Kaplan and Norton's balanced scorecard model. Kaplan and Norton argue that measures of business performance should be broadened to ask the following questions. How are we looking from a financial perspective? How are we looking from a customer perspective? How are we looking from a process or operations perspective? And how are we looking from a learning and growth perspective? Where possible, reliable methods of measurement should be used to quantify success in each of those fields. Outline Elkington's triple bottom line. Well, this is the 3 Ps, profit, people, and planet. Elkington recommended that judging a business's performance should be extended to include how it is treating its employees and how it is reducing its environmental impact. What is a tariff? A tariff is a tax on imports which raises revenue for the government and makes imports more expensive, giving domestic companies an advantage. What is a quota? A quota is a strict numerical limit on the number of items allowed into the country, creating an artificial reduction in supply and a corresponding increase in price. This benefits domestic suppliers as they are unaffected. What is a trade embargo? This is a complete ban on imports, for example, cannabis or other drugs, or a complete ban on exports, for example, arms. What is a subsidy? So a subsidy is where the government gives grants to companies, enabling them to produce more cheaply. They can sell on international markets at a lower price than their international competitors. What is economic growth? Economic growth may be defined as an increase in gross domestic product from one year to the next. In other words, the country has created more goods and services this year than it did last year. What is the EU? Well, the European Union is a single market comprising 27 European countries. There are no tariffs, tax on imports, or quotas, which is a strict limit on the quantity imported, between member states. There is also free movement of people and capital. What does this graphic demonstrate? Well, it shows increasing levels of integration between countries, starting at the bottom with a free trade area, which means there are no tariffs, that's taxes on imports, and no quotas, limits on the physical numbers of imports. Then we have a customs union, where those countries apply a common external tariff, which is a tax on all imports from outside the free trade area. Economic union. This means a single currency, for example, the euro, one central bank, and a single monetary policy, which is basically one interest rate set by the European Central Bank. Political union. This will be a United States of Europe with common monetary and fiscal policy. What is the purpose of competition law, and which organisation monitors competition? The law aims to promote healthy competition. It bans anti-competitive agreements between firms, such as agreements to fix prices or to carve up markets. It also makes it illegal for businesses to abuse dominant market position. The Competition and Markets Authority, the CMA, is a government body that investigates potential breaches of this legislation. It has the power to fine companies and to break up monopolies or prevent monopolies forming by banning acquisitions and mergers that they consider to be against the consumer interest. How do laws protect the environment? Businesses have limits on the amount of carbon emissions they can produce, and this is enforced by local authorities. Water and land pollution are regulated by the Environment Agency, and the landfill tax is designed to limit the amount of unrecyclable waste that business produces. There are also packaging and waste directives designed to reduce pollution, for example, compulsory charges for plastic bags. These regulations inevitably incur a cost for the business. However, some businesses embrace these laws and use them as USPs to try and improve their brand and demonstrate corporate social responsibility. How do laws protect consumers? They prevent businesses exploiting consumers or cutting corners on consumer safety. Some examples being the Trades Description Act, advertisements must not be misleading, sale and supply of goods to consumers regulations, goods must be as described, fit for purpose, and of satisfactory quality. The Consumer Protection Act, products must be safe. And then the Data Protection Act, consumers' data should be stored securely. How do laws protect employees? The Equality Act 2010 protects employees from race or sex discrimination. For example, equal pay for the same value of work. Both genders must be paid the same for the same job within the same company. Minimum wage, firms are not allowed to pay below a certain amount. For example, £9.50 for a worker aged 23 or over from April 22. Why are some industries regulated? These markets are mostly oligopolies. This is markets dominated by a small number of companies. As a result, there is an unfair balance of economic power between consumers and the businesses. So Ofgem regulates gas and electricity markets and tries to prevent overcharging. Ofwat monitors water, Ofcom monitors telecommunications. They all have the power to intervene in the market to prevent consumer exploitation. What determines long-term economic growth? An increase in the available factors of production, such as land, labour, capital, and entrepreneurial talent, such that increases our productive capacity. Why is growth good for business? An increase in GDP means people are spending more, which equates to more sales for businesses. This in turn increases revenue and profits. Explain the diagram. Well, this is the trade cycle, which shows a pattern of booms, high demand, and slumps, low demand. The trend line indicates whether the long-term picture shows an increase or a decrease. Define inflation. This is a general rise in prices with a corresponding fall in the purchasing power of money. Why is inflation so damaging? Interest rates will tend to rise as banks incorporate the rate of inflation into their loan charges. This will discourage consumers from borrowing and add to the finance costs of businesses. Firms will also have to keep repricing their products. Now, if the UK inflation rate exceeds that of other countries, businesses will find it harder to sell abroad as UK products will gradually increase over time. Firms use money as a measure in both the income statement and balance sheet. Where the value of money is changing quickly, it is necessary to adjust figures for the rate of inflation to get a more accurate picture of performance. For example, if a firm made a profit of 40 million in 2020 and then 42 million in 2021, at first glance, it looks like profits have improved. However, if we learn that inflation is running at 10%, then profits should have risen to 44 million just to maintain performance. So the real performance has actually deteriorated. People on fixed incomes, i.e. those whose income does not increase as quickly as inflation, will find that their purchasing power has declined. They will be unable to buy the same amount of goods. Also, the value of people's savings will be reduced. What is an exchange rate? This is the value of one currency expressed in terms of another. For example, £1 equals $1.3. What is the mathematical rule for converting between currencies? Well, if we are exchanging pounds to a foreign currency, we multiply by the exchange rate. If we are converting foreign currency to pounds, we divide by the exchange rate. Why is exchange rate volatility a problem? There is often a time lag between an order being made and actually paying for it. If the exchange rate moves between these times, then the actual price paid could be more or less than planned. Let's look at an example. If a British firm makes an order of 100 widgets from a French firm, each at €240, at an exchange rate of £1 equals 1.2 euros, they are expected to pay 240 divided by 1.2 times 100, which will be £20,000. But if the exchange rate weakens to £1 equals €1, then they will pay 240 divided by 1 times 100, which is £24,000. So just because the exchange rate has moved unfavourably, the British firms end up paying £4,000 more than they first thought they would. What is monetary policy? This is where the government seeks to increase or decrease economic activity, that is, the amount of goods and services being bought and sold, by raising or lowering the rate of interest. Raising interest rates makes borrowing more expensive, which deters consumers from buying products that have to be financed by borrowing, especially houses and cars. In addition, people's mortgage payments will increase, which reduces their disposable income. These two events reduce overall demand and therefore reduce the inflation rate. What is fiscal policy? Fiscal policy is the deliberate manipulation of taxes, public expenditure and government borrowing in order to achieve economic objectives. The government taxes the population and then spends it on services like education, health, defence and social protection. In so doing, this activity will impact on the economy. If the government wants to increase economic activity, it will spend more than it taxes and finance this through borrowing. If it wants to decrease economic activity, it will tax more than it spends. What is protectionism? Protecting domestic businesses from foreign competitors by using tariffs, quotas and subsidies. What is globalisation? What are its origins? Globalisation is the ever-increasing interdependence of the world's economies, cultures and populations. This is fuelled by massive flows of cross-border trade, technology, investment, people and information. The origins come from the development of the internet and containerisation, which in turn has helped the development of huge multinational corporations which now dominate world trade. What are the BRIC countries? Why do they present threats and opportunities to UK companies? The BRIC countries are Brazil, Russia, India and China. They are emerging economies with huge natural resources and represent a huge potential market for UK exporters as their populations become wealthier. However, companies from these countries are able to offer intense competition to UK businesses. How can changing demographics impact on business? Well, items to consider will be the size of the working population, the size of the retired population, consumer lifestyle, social networking, buying patterns, urbanisation and migration. Explain the diagram. This is Carroll's hierarchy of corporate social responsibility. At the foot of the pyramid, we have economic, which means that the business's first priority is to make a profit in order to survive. Then it must obey all the laws set within the country. Then the next layer is ethical, which is about attempting to do the right thing and certainly to do no harm. Right at the top of the hierarchy, we have philanthropic, which is about being a good corporate citizen and contributing to the well-being of the planet and the people. What's the difference between a shareholder and a stakeholder? A shareholder is a person who owns part of the business and receives dividends, whereas a stakeholder is someone who is impacted by the activities of the business. Explain the diagram. This is Porter's 5 forces model, which is based on adversarial relationships. In analysing an industry, it is not just about competitors, but also about the impact of suppliers, customers, substitutes, and new entrants. Threat of entry. How easy is it for new businesses to enter the market, and what barriers exist to prevent them doing so? Bargaining power of buyers. Are there many customers or only a few? The threat of substitute products. Can customers buy an alternative product that fulfills the same need? Bargaining power of suppliers refers to the number of suppliers in the market and the cost of switching. Industry rivalry is about the degree of competition within the market. Using this model, we find one of the most profitable industries in the UK is banking, which has high barriers to entry, few substitutes, an oligopolistic market structure, a very large number of customers, and very low supplier power. Investment appraisal. It's about assessing risk against return. What is the payback period? This is the amount of time it takes a project to pay back the initial investment. For example, we have initial investment of £50,000, and then we have net cash flows over the following 4 years of 20,000, 15,000, 10,000 and 12,000. Now, after 3 years, we have a return of 45,000, but that means we haven't quite got our £50,000 back yet. Therefore, we need 5,000 out of the next 12,000 in year 4 to pay back the initial investment. So we look at the calculation to be 5,000 over 12,000 times 12 to get it into months. And we see that the computation works out at 5 months. This means it takes the business 3 years and 5 months to pay back the initial investment. What is average rate of return? This compares the net return on the investment in percentage terms. Average net annual return divided by initial investment times 100. So let's take an initial investment of £10 million. The net returns are year 1, 4 million, year 2, 5 million, year 3, 6 million, year 4, 7 million, year 5 is 5 million. When we add these together, we get 27 million. We now subtract the initial investment. So that's 27 minus 10 million gives us 17 million. We then divide by the number of years. So that's 17 million divided by 5 equals 3.4 million. Now we express it as a percentage of the original amount invested, which is 3.4 million divided by 10 million times 100, which gives us a return of 34%. What is net present value? Net present value takes into account the time value of money. Money received in the future is not worth the same as the identical amount of money received now. The reason being that the money received now could be invested and receive a return for that period of time. Future values are discounted back to current values by multiplying by a decimal fraction, which is called the discount factor. Let's look at an example. So with an initial investment of 10 million and using a discount factor of 5%. Each year's net return is brought back to a present day value by multiplying by the given discount factor. They are then added together, giving a present day total of 23.208 million compared to the unadjusted figure of 27 million. The original investment is then subtracted, so we have 23.208 million minus 10 million gives us 13.208 million. So this is a positive number, so the project is worth considering. What other factors might impact an investment decision? Well, can the business afford to lose the money on the investment if it goes wrong? Would failure threaten the existence of the company? The impact on stakeholders should also be considered. Is the investment a good fit with the business's mission and goals? What is sensitivity analysis? Sensitivity analysis tests the assumptions on which decisions are made and then gives best and worst case scenarios by calculating one variable at a time. For example, an investment is being considered where the belief is that sales revenue would increase by 5% per annum. A sensitivity analysis might rework the figures for a worst case scenario of 3% and a best case scenario of 7%. This gives management an idea of the degree of risk associated with the investment. Okay, this brings us to the end of the 3.7 section. So we're now going to do a multiple choice. So if you have this sheet in front of you, then that's great. If not, just write down 1 to 20 and then write the correct letter as we go through it. Question 1. A company publishes the following financial information. Sales revenue, 800,000. Cost of sales, 200,000. Expenses, 100,000. Capital employed, 10 million. Current assets, 50,000. Current liabilities, 20,000. Inventory, 10,000. Its gross profit ratio is A, 10%, B, 12.5%, C, 60%, or D, 75%. Question 2. A company publishes the following financial information. Sales, 800,000. Cost of sales, 200,000. Expenses, 100,000. Capital employed, 10 million. Current assets, 50,000. Current liabilities, 20,000. Inventory, 10,000. Its net profit ratio is A, 50%, B, 30%, C, 25%, D, 62.5%. Question 3. A company publishes the following financial information. Sales revenue, 800,000. Cost of sales, 200,000. Expenses, 100,000. Capital employed, 10 million. Current assets, 50,000. Current liabilities, 20,000. And inventory, 10,000. Its return on capital employed is A, 10%, B, 6%, C, 12.5%, or D, 5%. Question 4. A company publishes the following financial information. Sales revenue, 800,000. Cost of sales, 200,000. Expenses, 100,000. Capital employed, 10 million. Current assets, 50,000. Current liabilities, 20,000. And inventory, 10,000. Its current ratio is A, -2, B, 2.5, C, 2, or D, 0.4. Question 5. A company publishes the following financial information. Sales revenue, 800,000. Cost of sales, 200,000. Expenses, 100,000. Capital employed, 10 million. Current assets, 50,000. Current liabilities, 20,000. Inventory, 10,000. The acid test is A, 0.4, B, 2.5, C, 2.0, or D, 1.5. Question 6. In using the SWOT analysis model, which of these statements is correct? A decrease in taxation is a threat. B, a current ratio of 0.5 is a weakness. C, a rise in interest rates is an opportunity. And D, a competitor going into liquidation is a strength. Question 7. Statement 1. Strategy is a long-term plan. Statement 2. A mission statement is a general description of the overall aims of the organisation. Read statements 1 and 2 and then select the correct option. Question 8. Tactics are long-term methods of achieving the mission. Statement 2. Objectives are short-term steps towards the overall goal. Read statements 1 and 2 and then select the correct option. Question 9. A company has the following financial information. Sales revenue, 2 million. Cost of sales, 800,000. Receivables, 50,000. Payables, 40,000. Days receivables is A, 18.25%, B, 23 days, C, 9.1 days, or D, 18.25 days. Question 10. A company has the following financial information. Sales revenue, 2 million. Cost of sales, 800,000. Receivables, 50,000. Payables, 40,000. Days payables is A, 18.25%, B, 23 days, C, 91.25 days, or D, 18.25 days. Question 11. A company has the following financial information. Sales revenue, 2 million. Cost of sales, 800,000. Inventory, 50,000. Current assets, 200,000. And current liabilities, 100,000. The acid test is A, 0.5, B, 0.67, C, 2, or D, 1.5. Question 12. Statement 1. Kaplan and Norton's balanced scorecard comprises 4 perspectives: financial, customer, business process, learning and growth. Statement 2. Elkington's triple bottom line includes values for profit, net social and environmental performance. Read statements 1 and 2 and then select the correct option. An increase in interest rates is an example of which type of external influence? A, technological, B, social, C, economic, or D, political. Question 14. Monetary policy refers to the manipulation of interest rates to influence consumer demand. Statement 2. Fiscal policy refers to the manipulation of taxation and public expenditure to influence consumer demand. Read statements 1 and 2 and then select the correct option. Which of the following is not a problem caused by inflation? A, over time, UK exports become more expensive. B, people on fixed incomes are able to buy less. C, firms will have difficulty calculating real revenues and profits. And D, nominal GDP is likely to fall. Question 16. Which is not an element of Carroll's CSR hierarchy? A, be socialist. B, be ethical. C, obey the law. Or D, be profitable. Question 17. Which of the following is not included in Porter's 5 forces analysis? A, rivalry. B, buyer power. C, supplier power. Or D, stakeholder power. Question 18. A company has the following investment data: initial investment of 60,000 and net cash flows of year 1, 40,000, year 2, 60,000, and year 3, 50,000. The payback period is A, 1 year, 4 months, B, 1 year, 3 months, C, 2 years, 4 months, or D, 2 years. Question 20. When conducting a sensitivity analysis, a business confidently predicts sales revenues to be £200,000, but total costs are predicted to be £50,000 plus or minus 10%. What are the best and worst case profit scenarios? A, 250,000 and 240,000. B, 160,000 and 140,000. C, 150,000 and 140,000. Or D, 155,000 and 145,000. Well, that brings us to the end of 3.7. All that remains is to check your answers. So here we go. 1, D, 2, D, 3, D, 4, B, 5, C, 6, B, 7, A, 8, C, 9C, 10A, 11B, 12A, 13C, 14A, 15D, 16A, 17D, 18A, 19B, and 20D. Okay, that's it for 3.7. So I'll see you next time when we'll look at choosing strategic direction. See you then.